Hello and welcome to this Cornerstone Finance Group podcast brought to you by Business News Wales and sponsored by Moda Mortgages. I'm Gemma Casey, editor of Business News Wales, and in this episode we're going to be looking at the buy-to-let landscape. With growing interest in limited company buy-to-let and increasing complexity around tax liabilities, what do mortgage advisors need to know to best support their landlord clients? Well, with me to discuss this are Roger Morris, Group Distribution Director at Chetwood Bank, John McCaffery, Head of Tax and Tax Partner at Alexander & Co Chartered Accountants, and Sarah Hopkins, Mortgage and Bridging Broker at Cornerstone Finance. Hi all and thanks for joining me.
Morning, Gemma.
Good morning.
Roger, let's start with you. Before we get into this discussion, tell us briefly about Chetwood Bank.
Chetwood Bank is the latest bank to have launched in Wales. So it's a real claim to fame. I'm really proud of that. And we own CHL Mortgages for Intermediaries, which is a specialist complex buy-to-let lender, and Moda Mortgages, which is a buy-to-let lender, which is the newest buy-to-let lender to enter the UK property market. So a couple of firsts there, Gemma.
Thank you, Roger. And you joined us on the previous episode where we looked more generally at the buy-to-let landscape. But before we get into talking about tax in particular, Roger, give us a brief recap on how the buy-to-let sector is looking in 2025.
The buy-to-let sector at the moment is kind of going through, it's going through a big change for two primary reasons. One's the Renters' Rights Bill and that whole focus on the STs and the eviction process. And ultimately, that'll come out through Parliament and become law by the back end of this year. And the other big area the marketplace is challenging itself with, but is working its way through, and the world is definitely changing, is when it comes to taxation, which is what we are going to talk about this. Because when George Osborne announced interest relief removal in June 2015, it certainly changed the business model for a lot of landlords who may be high rate taxpayers who had reasonably high LTV, say 75%, and owned the properties in personal names. So the marketplace itself is definitely going through a professionalization, and it's also having to go through a lot of thought and decision about how to buy to lets and in what company structure. Certainly makes a big difference. And we're now seeing the vast majority, I think it's something like 92% of all purchases being purchased in a limited company. But I've never seen so many opportunities, Gemma. My last buy-to-let that I put on in Birmingham to rent out had 39 families apply for. So the demand is high, yet the industry average is somewhere between 12 and 15 families for property. And with interest rates dropping and rents personally have gone up 42% in the last 3 years, I've never seen a better time to be in buy-to-let. However, the one thing as a landlord I would make sure I had was someone like Sarah to advise me on mortgages and someone like John to advise me on tax.
That is a great picture you paint for us there, Roger. Thank you. John, to come to you then. So Roger has touched on it there, but I'm keen to know a little bit more about the current tax implications for landlords and how that landscape is really shaping landlord behaviour.
Sure. So I think Roger alluded to it then. The current landscape kicked off back in 2016. George Osborne came along and he changed how landlords were taxed. Um, the key change was basically previously all of your interest costs were tax deductible. So put it very simply, you'd have your rental income, you would take off your interest cost, and then you were taxed on the profit you made if you made one. Yep. Um, the change that George Osborne introduced, that was phased in over a period of 4 years, was that what happens now is you take your rental income, you'd knock off your repairs, but for simplicity's sake, we'll just say you take your rental income, you're taxed on your rental income, so which is a much higher figure because it's before interest deductions. So you're paying much more tax. And then you will get a deduction for 20% of your interest cost. Now, the unforeseen circumstance of that is those number of people were brought into high rate taxes, paying 40%. A number of people, particularly as interest rates went up, were finding that they were actually paying tax whilst making a loss on their rental portfolio because the interest costs were so high that they weren't making any profit. But because the tax relief was low, they were ended up paying tax on it. Outside of that, the rental landscape or the landlord landscape in terms of tax hasn't changed a great deal. What it is that there's a lot of assumed knowledge that isn't correct. There's a lot of, or there have been less so now, providers who are selling the dream that doesn't exist. And landlords' tax position is very much determined by their own circumstances. So a husband and wife retired with 3-4 properties as a rental income, who were basic rate taxpayers, are in a completely different position to say 2 or 3 professional landlords with 30-40 properties. And it's not a one size fits all. When you come to property, there's a number of tax issues that kick in. There's the stamp duty land tax, and we all know about it's not actually, it's land transaction tax in Wales, forgive me. The increased rates for second homes or second properties, and the complexity about when that applies. There is, if you're moving properties from own ownership to limited company ownership, or you're passing it on to your children, there's capital gains tax that needs to be considered. Properties are subject to inheritance tax, and there's a lot of interplay and set off between the taxes that leads to a lot of complexity about taxes that people make assumptions about and quite frequently get wrong.
So, a real role then for tax advisors like yourself, John.
Absolutely, yeah. It is. I mean, I spend my days within the tax legislation talking to entrepreneurs generally because there's a lot of property entrepreneurs or entrepreneurs who own property. Um, and the key very much is to understand the circumstances you're dealing with and then apply the taxes to those circumstances. Not, and I just throw it out there, not the kind of like, well, if you set up in a partnership and move from a partnership to a limited company, then you're saving the stamp duty, land tax, and you're saving the capital gains tax. One, it might not be relevant for you. Two, that's not necessarily the case at all. You've got to look at all the circumstances going on and follow a very detailed set of rules in order to make sure you're getting what you want out of it and also getting the reliefs you can claim.
So, yeah, very much a case by case basis. We did start off this episode, John, talking about the fact that there is increasing interest in limited company structures for property ownership. Tell us a little bit about that.
Okay, so it comes down to tax is all about percentages and differentials. And as I said, what on the interesting there, a lot of people are being brought into higher rate tax. So you're finding yourself in a 40% tax bracket. There are numerous landlords, let's say, just on property income alone, you tip over the £100,000 mark, you're in 60% tax. If you're a landlord who actually earns a salary and you've got 2 or 3 properties, again, you could find yourself tipped into that 60% tax. And it's not too far off because once you're above the 60% tax, you then fall into, and it's a bit weird, but you then fall back into a 45% tax rate. Yep. Companies pay tax at 19 or 25%, and they get full relief for interest. Yep. So there's an obvious attraction there. There's a much lower tax rate available if you are operating from a limited company. That is provided that you're leaving your profits within the limited company, or you're able to set up your shareholding such that you can spread the profits around a number of shareholders who are on lower tax rates to take advantage of their personal tax allowances. If you are simply setting up in a limited company and taking all the profits out, you're actually in no better position at all.
Okay. Yes. So, yes, the nuances keep on coming, don't they, John?
They do.
I'm going to move on to Sarah for a minute. We have heard there, Sarah, that there will be times when a landlord might look at moving to a limited company buy to let. What are the key differences between personal unlimited company buy-to-let borrowing that mortgage advisors need to be aware of?
Different things, Gemma. So, first of all, it's not every lender will offer limited company mortgages, and of the ones that do, it's very much horses for courses, because you could get like a super simple structure where you've got like a husband and wife and they're both directors, 50-50 shareholders, really, really easy. And we'll be able to put that with the more sort of vanilla lenders. But then on the other side of the coin, you've got structures where maybe you've got like a holding company, or you've got like a shareholder who's an expat living out in Hong Kong, or you've got a few little different sort of nuances there. Um, and that's going to have to go to a more complex lender. So it's really important for an advisor to understand the differences of what can go where, basically, and it's not all the same. Biggest difference that it makes in terms of lending is all about the affordability. So when the lender does their stress testing, which is just basically all the calculations they're doing in the background to determine how much the client can borrow, it's based on the rental income rather than the client's personal income. But the stress testing is much gentler for a limited company than it would be for a higher rate taxpayer. So it does make a big difference in terms of how much you can borrow. Um, the underwriting is, I think, sort of people think, well, it's a company, so it won't have the same underwriting. But really, it's almost, I kind of say it's like a tax, just a tax wrapper around the person. So the underwriting process is still the same. So the lender's still going to want like proof of income, bank statements, etc. So that part of it's the same. But then there are a couple of differences in the process. So things like you might have a couple of extra hoops to jump through, like you're going to need a personal guarantee. You're going to need to sign a personal guarantee. And the lender needs you to have independent legal advice, which is basically you go into a solicitor, having it explained to you that you understand that the mortgage debt is on your head and it's not just forgotten with the company. And then there's some additional costs around that. So yeah, there's just a couple of extra steps. It's virtually the same, but with a couple of extra steps added.
And if I were a mortgage advisor listening to this, Sarah, and I might think, oh, that I wasn't aware of that, or I'm vaguely aware, but I think I need to know a bit more. Tell me a little bit about what the Cornerstone Network does to support the advisors within your network with gaining knowledge and, really importantly as well, the confidence to really serve their clients well with all of this.
Gotta be honest, we're really lucky at Cornerstone. So we've got frequent BDM meetings, and oh God, you really do have to make BDMs like your BFF, because they're the ones who like they know all like the super. And I know this because I used to be a BDM. They know all the super like intricate bits. So you need to make good friends with them. So, but we get introduced on a weekly basis. Specialist lenders will come on like a webinar or a Teams or whatever, and sort of like teach us all these extra little nuggets, and that's so useful. Cornerstone also hold things like regular like annual expos where you've got like all the lenders at one event. And you'll get someone like Roger coming in and speaking on like a specialist topic. So there's always plenty of opportunity for learning. But I would say over and above that, I mean, you can't just rely on your network to do everything for you. Like I say, you've got to make the relationships with the BDMs, but also like subscribe to industry newsletters and website, and actually read what comes into your inbox. Like I know, you signed up to all these lenders and you get like 1,000 emails in your inbox every day with like updates about this and updates about that, but some of them are actually really important to be reading. So yeah, you just need to like immerse yourself um with the people who know what they're talking about, basically, and yeah, it will absorb.
Thank you, Sarah. Roger, so Sarah there has mentioned that for a mortgage advisor, their BDM is their BFF. I love that line. How catchy is that? But what else would you suggest advisors need to understand to serve their clients effectively when it comes to buy to let, and really crucially, to know when to bring in tax professionals like John?
Yeah, I mean, I really do uphold everything Sarah says about the BDM would really become invaluable. But also, the BDM needs to realize the mortgage advisor is invaluable as well. There's a lot of BDMs that just don't rate the mortgage advisor in the way they should. They don't return phone calls to help them. So if you get a good one, then certainly look after them. And it's one of the key points. Is definitely worth remembering on the value a BDM can offer. What I would say when it comes to the technical side, So often, mortgage advisors get really worried, Gemma, about they are perceived to be giving tax advice and they're not, they're giving information. So you need to explain the differences between a limited company and personal ownership exactly the same way you would explain the differences between a fixed rate and a discount mortgage. You're not actually advising on, right, I'm going to give you a discount or I'm going to give you a fixed rate. I'm just going to, first of all, just explain how the two work. And really, this point brings it home when it comes to first time buyer, first time landlord. If you were to ask 100 mortgage advisors who they would pick for first time buyer, first time landlord, they'd pick a very well known top 4 high street lender who only does buy to let in personal names. And therefore, by putting it with that lender and putting it in personal names, what that ultimately means is when they go for their first ever residential, they'll have to pay that extra second home stamp duty, which in England is 5%, but in Wales it's 6%. And it really does impact massively on the client. And ultimately, the landlord, the mortgage advisor could be or end up having to pay the compensation when it comes to stamp duty. So the importance of making sure that the customer is properly advised and that they fully understand the implications of that structure of ownership and they don't just focus on the rate, because so often people will think £500 a month is cheaper than £550 a month, even though 500 is cheaper than 550. It's whether or not what is the ultimate net income position after tax, because to a high rate taxpayer, they can only offset just 20% of the mortgage payment, but in a limited company, you could potentially offset 100%. So that's why I really feel it's hugely powerful to have a brilliant advisor like Natalie who really knows what she's doing and is really focused and has that experience, and John with the tax advice, and then with a lender that is able to help educate and upskill. So all three of us work in a very sort of positive way, I suppose.
So it's really looking for that tripartite relationship that can support the landlord at every stage of their journey. John, does that
Yeah.
resonate with you?
Very much so. A lot of my work comes from when it's gone wrong. And it does. I've spoken with Roger quite a lot about this in the past. I do a lot of these kind of things, webinars, training for organisations. Roger's dead right. I did the first time buyer. So he was alluding to the fact a first time buyer go and get a mortgage in your own name, and if you do a buy to let in your own name, you lose the opportunity to claim your first time buyer's transaction tax relief on your first property ever, right? So it costs you a small fortune. The other ones I hear very regular, and this is after years and years of doing this, Gemma. I'm going to transfer a property to a limited company, but I'm going to sell it for £1 because it's my limited company. And it doesn't work. There's a market value transaction there. I'm going to gift shares to my children. Well, there's a capital gain there. There is all sorts of things people think you can do and you can't. And it ends up with big tax costs that you weren't expecting. So it's worth taking some advice. Take some advice up front, and then I think what Sarah was saying before about the mortgages and whether it can be done in a limited company. She's dead right. Tax is another cost, and that's why you need all three parties involved. From my point, if you can get all the tax advice in the world, but you can't get borrowing, what's the point? Whereas on the other side is if you've got the kind of, as we were saying, the first time buyer, if you've got the wrong kind of mortgage in the wrong kind of structure, could equally cost you a small fortune.
I make it my business to make sure I've got a couple of like decent accountants and tax professionals on hand, people who I know can be relied upon and they know what they're talking about because that's their area of expertise. It's not mine. So if a client's a little bit, say, clueless because maybe it's like the first time they're doing it or they're just not sure, it's only my job to say, like, whoa, stop. Have you considered this? And this is who you need to speak to. And I know that I can signpost them to somebody that's going to give them proper advice before they jump in. So everything all works as a connection.
And Sarah, on that, so you clearly are in a really fortunate position that you've got strong contacts with lenders, with tax advisors, and so on. If there were a mortgage advisor listening to this who perhaps is young in their career or feels that they don't have that go-to person, what is the support on offer from the Cornerstone Network to help them develop those really strong relationships so that they can signpost with confidence?
So I mean, networking events are great, but also like Cornerstone works in like a big group structure where you've got different avenues that you can refer off to. So, you've already had people kind of vetted, if you like, professionals that are vetted that that you can rely upon to refer business to. So things like that are really, really helpful. But again, like I said earlier, like it's not like the network offers great support, brilliant support. But if you want to be a standout advisor, you've got to do those sort of additional things as well. So, take it off your own back, like go and attend networking events that are out there. And like there was a time when I was looking for a really good accountant, to be able to refer to. And I went to a networking event and just, they're going around the room and, stand up and tell us, what you're here for, what you're looking to get out of it. And I stood up and said, I'm looking to make a really good relationship with a tax advisor. And then, conversations come off. And there's nerve wracking to do that for the first time, but you just got to put yourself out there and in front of the right people.
Mm. Roger, is that something that is that the sort of advice that you would give to anyone in sort of any part of this relationship? We've mentioned the three sides of that triangle, if you like, that really it is about relationships and confidence.
Yeah, it is. It's very much about your own personal development and having that understanding of not what a lender does, not what a tax advisor does, what a mortgage advisor does. It's about being able to give factual explanations and have the confidence of saying, "Look, Gemma, I'm not a tax advisor, but let me explain factually the differences between the two. Um, Also, let me think about what will the future hold, and how will your life change, and what do you want to do long term?" Because Gemma, if I look at you now on screen, you're in your mid to late 20s, and I look at you now, and I
I
think to
wish, Roger.
myself, well, I can only go for what I see. Um, and it's about going on this journey. So how many buy-to-lets you're going to have? Now, a lot of the times people underestimate what they end up having because success and buy-to-lets do well and they move on, and suddenly but they only intended to have one and two and they end up with 10. And it's about really understanding the potential of what could come and what could happen. And really that importance of having that confidence of dealing with Sarah and what Sarah can really do for you. And the customer really needs to value Sarah and her advice, and just what good value that Sarah will offer them, and the importance of protection and the insurances, and the value of what a good tax advisor like John, who can not only be your tax advisor, but be your accountant as well, and have that joined up approach that ultimately will deliver your best return for you and your family. Because buy to let now is just set to explore, because we're not building the houses. We never will, that any government would like to build because of all sorts of reasons. So but there's the value of rental homes will only ever increase, Gemma.
Mm. Well, I'm conscious of time. We have covered an awful lot in this episode, so I'm going to put you all on the spot to finish up and ask each of you which one piece of advice you would give to mortgage advisors listening to this on supporting clients with the tax implications around buy to let. John, I'll start with you.
It's a bit of a double barrel thing. One, assume knowledge is a dangerous thing. And secondly, everybody's circumstances are unique to them. And as a result, you should seek advice specific to those circumstances, not assume that actually there's a generic solution available.
Great advice. Thank you, John. Sarah?
Then I would sort of echo what John is saying, really. It's not a one size fits all approach. Every client's circumstance is different. So you need to really listen to them and take on board what their plans and what their journey is going to be, and just make sure that they're appropriately signposted to the right professional.
Thank you, Sarah. And Roger, the last word to you.
I would really advise or encourage mortgage advisors to work in partnership with a good tax advisor. And often you will hear, if I was a landlord being interviewed with Sarah, and Sarah recommends that I speak to a good tax advisor, that the landlord will say to Sarah, well, how much will that cost? Where the answer will be, how much will that save? Because speaking to a good tax advisor in the vast majority of times will be the best decision you've ever done, because at least then you can go forward and build with confidence. And the advice that Sarah will give you will be laid on that concrete foundations.
Great advice to end on there. Well, thank you so much to my guests, to Roger, to Sarah, and to John. And thank you for listening to this Cornerstone Finance Group podcast.